Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant. Welcome back to the Smart Property Investment Show. Hope you're well. Getting stuck into finance today, which we chat a lot about. You would have seen some headlines coming out over the last little period of time. Newsflash, and a lot of people may not have noticed it or seen it, but I certainly saw it when it came across my desk. And you would have seen a story on smartpropertyinvestment.com.au that Macquarie has decided to pull back from lending in trusts or companies, and they've cited a couple of different reasons for that. I've been talking about this for probably 2 years or so, telegraphing that I think there will be some shaping of lender policy and potential APRA-orientated attention towards trust-based lending. They're citing AML regulation or legislation connected in with it, but they've also cited the fact that there's a lot of, inverted commas, property spruikers out there spruiking the idea of you can continue your investment journey and sort of curtail some of the restrictions or requirements around serviceability by trust-based lending, assuming that you can get letters from accountants and all this sort of stuff. So I flagged this some time ago, and now we're seeing it bear fruit. What that means, well, Macquarie is out. They're going to be concentrating on personal name lending, so it doesn't mean that you can stop investing. You can invest in your personal name. Whether or not other whether or not other lenders follow suit is still to be seen. However, I am seeing and hearing inklings in the background that lenders are starting to tighten up their policies around these things as well. So watch this space. More information to come. It's still pretty early doors on it, but this has been telegraphed. And I have been cautioning a whole bunch of areas of this sector around this moving forward. Trust-based lending is certainly appropriate for many different investors. However, it seems to have been hijacked a little bit over the last period of time, and what we're now seeing is the ramifications connected in with that. So I'm not one to give advice or recommendations around it. These are just my views and opinions. So make sure you speak to your mortgage broker, your accountant, financial planner when it comes to these type of things. May change your strategy moving forward if it is harder to get loans for investment properties in and around trusts or companies. That said, though, there will be opportunities for other lenders to fill the gap, and where there is a gap and there is a demand, you'll quickly find people looking to service that. So you may see some innovation from some other lenders out there, but it looks as though, it sounds as though maybe the major banks are thinking about it. And we've seen Macquarie Bank, who services the investor market, pulling back from this. So go and check out the story, smartpropertyinvestment.com.au if you haven't seen it yet. There's going to be a lot of carry on stories related to it as we get more interpretation from it. But I'll give some views and opinions moving forward as well, how that pans out. But that's not what I'm here to talk about today. I'm here to talk about investing in your self-managed super fund, which essentially is a trust. However, there is different rules and different lenders and a different regime that certainly governs it. SMSFs have gone in and out of favour for many years. I would say that they're certainly in favour with property investors moving forward for some of the reasons I spoke about why lenders are tightening up, and Macquarie Bank specifically tightening up in investing in trusts and also in companies. But it's a different structure. It's a different vehicle. It's a lot more mainstream. It's a lot more connected, and there's a lot of Australians who are leveraging their self-managed super fund for property investment. Join him in the studio. First time we've had him in, and I'm sure we'll see him as a regular appearance on this from Finni Mortgages, Costa Arvanitopoulos. How you going, Costa? Good to see you, mate.
Great, Phil. How about yourself?
I'm pretty good, mate.
Thank you for having me.
So recently joined Finni Mortgages, team over at Finni.
7th week, I believe it is. Yeah.
How's it all going?
It's going really good.
Yeah.
We're really busy. SMSF is one of the main vehicles that we do for a lot of our clients.
Yeah.
So, yeah, thought it would be great to get onto the podcast and discuss it in further detail.
Have a chat about it. So you've been a mortgage broker for a little while?
Yeah, 2.5 years
Okay.
now.
Yeah. How you find it? Enjoy it? Good job?
It's good. Yeah. It's good when you can help a family or, people get on the property ladder, help that family buy that family home with the backyard for the kids. It's a rewarding industry.
Yeah, it's good. What were you doing beforehand? Someone was always something before a mortgage broker. So
yeah,
what were you doing,
I was in the coffee industry. I worked for Toby's Estate, so I was doing that. Still love my coffee. Still make it every single morning.
Oh, very good. How do you have your coffee?
Black filter.
Did you start with an espresso or you straight?
No, just a V60. So
really,
all manual.
V60.
Yeah, very manual. There's no machine. It's all by hand. And
Is that the thing you put on a stove? Is that what it is?
no, it's got like a little cone thing, and then you
Yeah.
put like a filter paper in it,
Yeah.
and then you grind your coffee separately,
Yeah.
put it in, and then you've got your gooseneck
Yeah.
water thing, and then you just do it, and then it just slowly drips out. It takes about 10 minutes.
Okay.
Sometimes I can't be bothered in the morning, but, the taste just gets me.
How many
every time.
coffees would you have a day?
One, maybe two.
Oh,
Yeah, I don't have so much. When I was working for Toby's, I was having quite a bit. Because, you have about a 5-minute break and you're like, I'll have a coffee.
A quick
I'll have a
coffee. I'm sure it's pretty accessible as well, right?
Yeah, it's just, you just get someone else to make it for you.
So
It's
you'd
there.
never be eating international roast out of a can, right? Or Macquarie, not
No.
your thing, but
No, definitely not.
yeah. Well, Australia's pretty well regarded, no matter where you go in the world.
Yeah, we
People
are one
rave
of the
about
best
our
at
coffee.
making coffee, so
Yeah.
it's a good place to be if you want to taste some coffee.
Yeah, and a good Greek name as well.
It is
Yeah.
a very good Greek
Yeah,
name.
yeah,
It's a very
you're not-
strong name, isn't it?
It certainly is. You're not. There's no second guessing. But the Greeks are great property investors. They've been
Yes,
investing in
they
Australia.
are, they are.
Yeah, half the cities, I think, is owned by the Greeks. or Melbourne.
I wouldn't mind owning the other half.
Yeah, I know. No, it's cool. Well, it's good you joined the Finni team, and we've had a whole range of brokers from Finni come to the studio, and they've all got their particular bent and their specialisation. You would have certainly seen Eva and Julie and Rebecca on the podcast, and it's good to be able to get a whole bunch of people from that business to come and have a chat with us to see what they're doing, what they're seeing. The best thing about chatting with brokers or a whole bunch of different brokers that they're all getting different conversations, having different conversations with people. We'll chat about SMSF lending specifically in a moment, Costa. But what's sort of the overall positioning of most investors at the moment? Are they pretty optimistic? They're pretty ambitious? Well, what are you chatting with people? Is it people recycling debt, or is it mainly, new purchases, expanded purchases? What are you seeing?
Yeah, we're finding a lot of new purchases. People want to get on the property ladder. The media help by hyping it all up that, prices are going to go up. So people sort of get that FOMO where it's just like, what, I've got to get on the ladder. I've got to get on the ladder. And, what we found, and, we'll relate it to SMSF, is where they're maxed out in their borrowing capacity in their personal names. And it's like, well, how can I get on the property ladder without it affecting my day-to-day living, spending, and finances? And that's where SMSF comes into play.
Yeah.
It's like, all right, I've got $200,000-$400,000 in SMSF. What can I do for it? People don't think they're doing much in an industry super fund. It's just sitting in international shares, Australian shares, and whatever else. And they're like, I probably prefer that to put in a property that I can manage, I can choose, and I can run to a point, obviously, the way that I want.
It's you're absolutely right. It's an iterative thing where people they might have a principal place of residence and they start investing in property. Now I get to a point where they reach these serviceability caps, and I spoke about it beforehand. A lot of them would have been put down this pathway of investing via trust, and that's getting tightened up.
Yeah.
But the obvious extension for most people is self-managed superannuation, and it could be a great vehicle for continuing to invest in property. However, it does come with some restrictions, and there's quite a lot of oversight and compliance connected with it. Well, there's certain things you can and can't do. So
you can't get equity out.
You can't get equity out. You can't do equity loans. You can't leverage all those type of things. So the idea is that you get your money in there and it stays in there. Let's get stuck into it. We'll go to a quick break. Stay with us back in a moment. G'day, Phil Tarrant here. Before we get back to the Smart Property Investment Show, I want to share something important. Yeah, that's right. They got me doing adverts now. But seriously, as an investor myself, I know how critical finance is. For years, I've struggled to find a consistent solution that supported my property investing journey. That's why I was part of setting up Finni. Finni's a mortgage broking business built exclusively for property investors. They understand the complexities, they deal with investors, and no matter how tricky your finance needs are, they've got the expertise to make it happen. So if you want to get finance ready and invest the right way, make sure you're backed by the right broker. Talk to the team at Finni Mortgages and find out how the right finance strategy can help improve your investment outcomes. You can book a consultation today. Visit finni.com.au. That's FINNI.com.au. Welcome back, Phil Tarrant, Smart Property Investment, chatting with Costa over at Finni Mortgages. Now, so let's go back to basics. Why SMSF for investing?
Well, I think it's just a great vehicle. You've got hundreds of thousands of dollars in your self-managed super fund. You're better off making it work for you. And property, especially property in, Australia, especially your metro areas, are just going to provide those yields and those gains over the years for you. And then once you hit retirement age, that income is tax-free. So it just it makes sense. Also, purchasing that family home, it's getting more and more expensive. So your borrowing capacity is going to get tighter and tighter and tighter. Whereas to some people, say for example, this year they're going to purchase a property for them and their family, they're going to max out their borrowing capacity, but they still want to invest. Well, how do I still invest when my personal name's maxed out? Well, you've got your super. So then that's why people are moving over to their super, because they want to get on that property ladder. And depending how much money they have in that, they may buy one or two properties. And then by the time they've done that process, their borrowing capacity in their personal name has increased, and then they'll start going again in their personal name. So it's sort of just like you're steering a bit to the other side to invest, and then bringing it back to your personal name when that borrowing capacity increases.
It's a really good point, because if people are buying a principal place of residence, typically they will probably get the most expensive property that they can afford based on their ability to service the debt, which means that for many people they're tapped out instantly once they buy their principal place of residence. So they may not be able to buy investment property outside of super for some time until either that principal place of residence grows in value, they're able to extract equity to draw that out.
The median
to
house
invest.
price in Sydney for a single dwelling is 1.75. I think it recently got announced.
It's up there.
It's
Right,
up there,
it's
and
up
that's
there.
just the medium. Let's be honest, like the property, if you're looking at anywhere within 15 k's of the CBD, you're looking at more. And it's just getting harder and harder to be able to purchase in multiple investment properties, plus get that principal place of residence that people are hoping for.
So a lot of people make the choice that they either buy a principal place of residence and then don't invest in property, or they invest in property and they're inverted commas rent investors, and there's certain cycles.
That's becoming more and more popular.
Yeah, but what you're saying is that once that serviceability threshold is hit, which may be investing in property and or your principal place of residence, the self-managed super fund is somewhere where you have the capital. You might have $300,000-$400,000 if it's a couple, and you can deploy that largely straight away with all the rigor that comes with investing in property. So that doesn't affect your serviceability at all. It's independent. The serviceability inside of your super fund,
it's totally independent.
Is
It basically comes down to the rent that you're going to be getting from the property that you're looking to purchase and your contributions from your employer. It's basically, that's it.
So a lender will look at if it is negative, and if you're buying a residence property inside a super fund at 90 or 80%, you probably good chance got to be negatively geared from the get-go. The contributions you're making from your income that you generate will be seen to be enough to enable the serviceability to stack up and satisfy the lender.
Correct. Yep.
Yeah. And I think this is, once people sort of start to understand this, they start thinking about it differently. One of the issues you have with self-managed super funds and buying property in self-managed super funds is that, earlier, let's call it 10 years ago, there was a lot of ineffective and probably inappropriate inverted commas advice or spruikers operating and acting in this space. And quite a few people got burned through schemes related to this, but it's certainly stabilised now, and I'd say it's normalised a lot as well.
100%, I would agree with that. Yeah, definitely has normalised. It's becoming part of the conversation now more frequently.
And do people call you up pretty much saying, hey, I'm investing, my financial planner, for example, or my accountant said to buy some property in my self-managed super fund, can you hook me up with a loan?
Yeah, pretty much, yeah. Or, they may have been at a barbecue on the weekend and then someone has a self-managed super fund and they've told them the benefits of it, and they'll give you a call saying, hey, I'm looking to do some investing through my super.
So what's the process then to secure finance inside a super fund? So assuming that the super fund is established and you need to use and leverage the appropriate advisors around that, probably an accountant. Once it is set up, how hard is it to buy property through your self-managed super fund?
It's not that hard. The only real sort of difference that you're looking at is when you purchase a property, on the contract, instead of writing your name like Costa Arvanitopoulos, you're going to be writing the super fund details on there, the bare trust deed. That's basically it. On a lending side, there is a bit more documentation that is involved, but on the purchaser side of things, not much else changes. It is fairly easy. People do have this perception that it is hard, especially the setup of an SMSF. But if you've got a good accountant, you can tell them on Monday, and by Friday you can have it all set up. And then as long as you've got a good broker, obviously, of course, they'll help you along the process with the documentation on what they need. And it is a very easy process compared to what people think it is.
Yeah, and you're leveraging the right people around it. And a good accountant will be able to educate you around setting up a self-managed super fund, ensure that you appreciate and understand the rules that govern it and the requirements from you in order to run that fund. Essentially, that's what you're doing. So there is oversight, there's audits, there's
you got to
additional
get
costs
audited
connected with
every
it.
single year, which your accountant will organise.
There's a lot more to it, but and to the point, it is like, buying the property. The purchaser is in an individual name. It's it'll be a bare trust set up specifically for the purchase of that property. But in terms of financing, you said that there's more documentation required. What sort of stuff's required from a financing point of view?
Listen, if you have had this SMSF set up, they do want the audits from the past 1 or 2 financial years. They obviously will scrutinise your contributions, the rentals, and they'll probably want financials, especially if you're self-employed. They'll ask for a lot more financials to make sure that those contributions are being made. And so it's overall a lot more documentation.
So for a lot of self-employed people, they may not necessarily be as compliant as they should be with super fund contributions, and they do them in big lumps, or they might do multiple years in a row. How much does that matter to a lender to actually see regular payment of contributions?
Well, they'll want to see regular payments. You can't just have one, 2 years ago, and then say you're going to be putting another one. They want to see each financial year regular payments to your self-managed super fund. Listen, if it's in big chunks, that's not an issue. As long as the money is going in there per year, they'll look at the total amount, not so much, he's making 26 or compared to 52 or 10.
So as long as at an aggregate per the super fund audits, it shows that you're making the
regular contributions every financial year
based on your whether it's the maximum contributions or the super contribution that if you're self-employed that you need to make on the behalf of whatever you get paid. So as long as they see the discipline around that they're happy from it. Okay, and you said also that they'd like to see company financials. What's the purpose of that? To make sure that there's longevity in your employment?
Yeah, they'll just want to see that your company is financially viable. They'll even do not so much an assessment, but they'll also want to see what your financial situation is. So they'll even ask for your income tax returns. Not that it's going to affect anything about your lending, but they want to see an overall picture of what the person does and how much money they're earning to make sure they're financially literate as well, because they don't want to be giving money to anyone ultimately. It won't affect the lending, but they want to see an overall picture of each member of the super fund.
And there's a lot of people setting up super funds, and I think it's going to continue. The retail and industry funds don't necessarily like
No, they don't, because you take the money out of it.
And I think they may have been behind some of the more recent sort of discovery the government's been having in terms of how they continue to tax it. We'll chat about that in a moment. But it is empowering for a lot of Australians, and you see them more and more people embracing it. What they need to be conscious and considered of is that there is a compliance regime they need to maintain.
Definitely.
A good accountant will keep you up the speed on it. And the type of property you buy in your super fund, and obviously we're talking about finance, the type of property you buy in your super fund may be different to those properties that you buy outside of your super fund. Again, I'm not offering any advice there, but there's a lot of rules around. You can't do, you can't, inverted commas, manufacture equity on the properties inside of your super fund. You can just do repairs and maintenance. You can't do significant renovations.
You can't knock it down and start rebuilding and stuff like that. Correct.
Yeah.
You can't get equity out. So there is rules around it. It's not as easy. You can't do whatever you want to it compared to a property in your personal name, where to a point, obviously, you can. But there's no equity. You can't just, build on top or knock down, rebuild. It's, quite strict in that sense. Yeah,
there are strategies around if you have the right type of asset, putting granny flats on properties inside of self-managed super fund. Again, you got to speak to your account, because the key thing is that you can't extract equity from it and use that money to do that.
So to do the granny flat.
Yeah, it's got to be like cash contributions, and you've got to get money into your super fund in some ways, and there's taxation ramifications of that as well. Retail industry funds, they'd rather you put the money with them and they can give you a great return. I'm sure
Yeah,
they'll tell you that.
on international shares or whatever else.
What are you what are the main hesitations you find with clients, or maybe sort of misinformation that they have when thinking about investing in property in a self-managed super fund?
Just the complexity around it. A lot of people do get frightened by, like, when you mention trust to them, a bare trust and all this sort of stuff, or my accountant has to do it. It's not as easy as just going to an inspection, just be like, I want to buy that property. I'll go to a mortgage broker, I'll get a loan, I'll go do it. Because there is a few more steps beforehand through your accountant to set everything up. It sort of makes people a bit hesitant. And it's not so well known out there. Like, the information's out there, you can very easily find it. But because, it's just not as common as normal investing, so people do sway away from it. But it's growing year on year. I was reading the other day, 3,500 new SMSF funds are opened up every single month, and majority of them are purchasing property. And that's just growing. I think it was about 5 years ago, it was like just over 2,000. So it is growing, and it will hit a point where it becomes, I reckon, the norm.
Yeah, I think so. More and more people, I found people are more financially sophisticated these days than what they might have been
Definitely
10 years ago. And you saw it during the GFC 15 years ago when a lot of people set themselves up for retirement, and then on the day of their retirement, they find their super funds and their dropping in value considerably. So there's a lot more ownership, I think, these days of people, their financial future. So I can see the benefits of a self-managed super fund. That said, you need to get the right advice.
Definitely.
In and around it, the assets you're buying, how you're structuring it, how you're financing it specifically, because it can be limiting and restrictive. So with non-recourse borrowing, it's essentially condensed inside the super fund. So if should your investment decision-making inside of your super fund not be a positive one, and there's issues with your funds, it's contained to the fund itself. So that's a good place to be, because it gives some sort of buttressing around other areas that you're investing in. But super fund lending and super funds in general are a great target for the government. They always have been for many years, and there's been quite a lot of noise around this recently. I want to have a chat about it, but we'll just go to a quick break. Stay with us. Welcome back. Phil Tarrant, Smart Point Investment, chatting with Costa over at Finni Mortgages. And if you want to have a chat with the team over at Finni Mortgages, I'm sure they'll have a yarn with you. Finni.com.au, that's FINNI.com.au, whether it's in your self-managed super fund or you're looking to leverage the market opportunities at the moment, get in touch with them. You go to the website. I'm sure you can track them down and you can have a good yarn with them. But Costa, there's been a lot of noise recently around the potential for additional taxation around self-managed super funds, and we saw the government was banning around the idea of taxing unrealised gains, which caused a bit of furore. And they've repelled from that decision making. They're not going ahead with it, which is good. And you got to question whether, why is there so much oversight and emphasis on self-managed super funds, and why is the government putting such an emphasis on it? It's a great incentive, and it's a great scheme that was introduced in Australia many, many years ago, and there's many nations the world over who look at the superannuation scheme in Australia and think it's a really good capability, and it's going to be, I hope, servicing Australia and Australians for many years ahead. But the government likes to tinker with the tax around it. So what was the outcome from that most recent stuff?
So it started off as unrealised gains, anything over $3 million, which was just absurd to begin with. So they scaled that back now. Now there'll be a threshold of $3 million. Anything over that will be taxed at 30%. So it's double from the current 15%. Then there'll be another threshold of $10 million, and that will be taxed at 40%.
And it's not that many super funds in Australia with a value over 10 million. But
no, I think it's like 8,000.
8,000. Yeah. But it's all going to be indexed now, right? So,
it's all going to be indexed to inflation. Yes, that's right.
And that was the argument from a lot of people sort of pushing back on that $3 million on unrealised gains, was that it wasn't indexed, so that number
Correct.
was going to remain like that. And as wages increase, people's pay would get bigger and bigger.
Exactly, that's right.
Yeah. So maybe some common sense has prevailed. They're still taxing at 30% over $3 million, so that's double what is south of the $3 million amount. But it's hopefully that the indexation stays in lockstep with the value of these super funds. But I would imagine the value of these super funds will probably perform better if the right investments are being made than maybe inflation inside of it. But who knows? It's got to be one of those things.
Yeah.
Costa, do you enjoy super fund lending? Do you enjoy
I really enjoy it. It's a really good niche, and I love educating people about it because, as we've mentioned, it's known, but it's not at the same time. And so many people, once they sort of discover it, because they do have so much money in super, that they love using the money to do investing, and it just grows their property portfolio and it sets them up well for retirement.
Yeah, and
because it is tax free.
It is once you get to the pension phase.
Yeah.
But just be aware that there is a lot more to it, investing from a compliance point of view, investing in your super fund, and when you get to a point when you're generating a certain amount of money, you got to start thinking about GST and everything connected with it as well. So it's like running a business. For many people, it's probably going to be their opportunity to run their own business. And guess what? You're in charge of the fund, which means you're the chief investment officer. That means you're making the calls on what you invest in and whether or not those returns are going to be appropriate for your needs. So you can't blame other people if you're making the wrong decisions inside of your super fund in terms of your investment allocations. It's completely up to you. So if that doesn't sound like you, keep your money parked with retail industry funds, and then it's someone else's job to make sure they get that right. However, if you want to take control, a little bit more control of your financial future, it can be a very good vehicle to do so. But again, make sure you speak to your accountant and other related professionals to get you across it. Give me a sense, Costa, there's a bit of flexibility starting to emerge with lenders in and around super fund lending as well. There was a period of time where very few lenders were touching it. There's quite a few more in the
big banks
market.
used to do SMSF lending. They've all now exited. So it's a lot of second tier ones. There's starting to be a lot more competition in SMS lending. We've got Pepper Money who are doing 90% LMI with no lender's mortgage insurance.
Okay.
You've got Granite who are
what sort of stuff is that freestanding houses for Pepper? Is
residential.
there restrictions?
Residential, up to $1 million.
Okay.
And you've also got Granite who are offering offset accounts.
Okay.
So they're the only ones in the market doing that at the moment. But rates are getting tight because everyone's competing with everyone. So it's good. You do pay a little bit of a premium for SMSF rates. They're not your normal, residential investor rates. They are a little bit higher in the sixes. But they're getting sharper as more competition starts vying for everyone's money.
Yeah. Okay. Well, watch this space. Thanks for coming in, Costa. It's good to have the chat.
Thank you for having me.
Yeah, and you're happy to have a chat with anyone that wants more details around.
Definitely. You can contact me on 0421 497 638. Contact me on LinkedIn or...
Is your email just costa@finni.com.au?
It is.
Okay, all right. There you go. That's it. COSTA at. I can imagine I'd miss.
Yeah, we had that discussion. Like, do you want to put the Arvanitopoulos? I'm like, let's just put Costa.
Let's just
make it easier.
Costa's easy.
Yeah.
Costa's easy. Costa.
Easy to remember.
Costa@finni.com.au. Good to see you, mate. Thanks for coming in. Remember, there's a lot to consider when it comes to investing in your super fund. It can be a great enabler and great vehicle for a lot of people to expand and continue their investment journey and even diversify a little bit as well. So speak to your accountant, speak to your broker, make sure you are leveraging the right people to make those investment decisions. We write a lot about it on Smart Property Investment. Go and check it out, smartpropertyinvestment.com.au. Like us, follow us, all that good stuff as well. And please keep the reviews coming on this podcast. We've been doing this for 10 years. We'll still get a kick out of it. That's a whole bunch of people are still tuning into this and leveraging it to make more informed investment decisions. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.